Good morning, everybody. It is April the 22nd, 2024. I am John Blank, Zacks Chief Equity Strategist and Economist, and today we're doing a piece on portfolio insights. We're going to look at top stocks in three sectors of consumer stocks: retail wholesale stocks, consumer discretionary stocks, and consumer staple stocks. Now, what we're going to do here is we're going to take six stocks that we find identified in our three different ways of looking at things, and we're going to look at them as a portfolio, how they perform as a portfolio together, how to get insights into their variation, their returns, and their correlations. So, fascinating stuff here for someone who wants to build a single stock portfolio. We're using major stocks that are very well respected. So this is a subject for a portfolio investor, most of all, how these things perform, how they relate to each other, how you can lower your variation and raise your returns. Classic stuff, and I think you'll enjoy it. All right, so let's go through our disclosures. These are my views, John Blank. I do have a PhD, and they are not necessarily the views of Zacks Investment Research. The rest of this you can read at your leisure. Okay, so first off, let's get through the retail and wholesale sector stocks. What we want to learn here is about their asset allocation, the characteristics of the stocks, and of course, the portfolio metrics. So let me take you through. This is the first one we're going to do. This is top stocks by market capitalization. Market capitalization. So they're really big stocks. And these are the ones in retail wholesale. So we're going to have top stocks by market capitalization in the retail wholesale sector from 8 years ago to now. Basically, the last 8 years. This will include the COVID pandemic. You're going to see that right here in the chart here. And it goes from April of 2016 all the way out to the end of March 2024. Now, over here, we're going to have one big set of charts that are kind of the baseline charts. Over here, we're going to have the story of these different portfolios, how we weight them, equal weight, overweight the first few stocks, overweight the last few stocks. So there's one equal weight, you can see. Here is listing above on this line, the overweight on these three stocks versus the last three. Here, the opposite. So again, this set of portfolios, weights assigned to each of the six stocks, end up creating these three different tracks, and then we study them all down here. Here's equal weight again. Here's the overweight the first three. Here's the overweight the last three. So keep this in mind. This will be the standard strategy for across this entire spectrum of stock portfolio management. So again, we're focusing on these both stocks and them in a portfolio context. So let's go through what we got here. Walmart, of course, ticker WMT. Lowe's, the home supplies company. Chipotle Mexican Grill. Of course, you know that one, fast-growing fast food chain. Amazon, Home Depot. Now, Home Depot and Lowe, remember, are in the same business. So let's be cognizant of what that characteristic plays out for these two stocks. Costco, of course, another big name and somewhat of a competitor to Walmart. So just looking across this, make sure you understand the businesses, the tickers, what they're doing. So the cumulative returns over these 8 years, you can see here. So what should you have bought? Well, this is obviously the case that Chipotle Mexican Grill, Amazon, and Costco were the best players. Walmart was actually the least good. So compound annual growth returns for these stocks, anywhere from a top line of 25.5% for Chipotle Mexican Grill, which is basically the same as Amazon, frankly. Next line would be Costco, and then, of course, Home Depot, Lowe's, and the final player at Walmart, 15% annual returns for Walmart. Now, interestingly, and of course, consistent with risk and return, is to get the 25% return on Chipotle Mexican Grill, you had to have a double the variation in returns that Walmart offered you. Lower return, lower risk over time. Higher return, higher risk over time. Of course, you all know that is the story, and this did indeed play out. However, now let's get into the variance covariance matrix, but I personally like the correlation matrix here. So let's take a look at Home Depot, for example. Home Depot has an 80% correlation to Lowe's, but 40% with everything else. So you can tell some business is related to another business in the same industry space if it has over half correlation, 0.5. Anything below 0.5, and it's probably not a relevant industry. So, for example, here Costco has strong ties to Chipotle Mexican Grill, Home Depot, and Walmart. So it's kind of interesting to see that, and all this is pretty consistent because Costco's a jack of all trades kind of place. Whereas Home Depot, really you see a different lower correlations to everything, but a much higher correlation to Lowe's. So that, of course, we all know why that is the case. Chipotle Mexican Grill, just because the stock was traded so strongly, like with Amazon, has a very high correlation to it. So it's not necessarily just an industry. And of course, we can look all the way through all these things and we can come up with these measures. So here we go. Portfolio measures, if we just take it equal weight, portfolio measure with Walmart, Lowe's, and Chipotle Mexican Grill, getting a little more weight. And then down here, over here, again, more weight. So what happens? Well, of course, the ones that overweighted the stronger stocks, which in this case would include basically Chipotle Mexican Grill, which was the strongest stock, did a little better, a lot better, 25% annual returns versus 20% average returns. So weighting a stock portfolio did matter. You could pick up an additional 5% return. Standard deviations, when you picked up that returns modestly higher. But a 6 versus a 5, I mean, basically not worth bothering with, right? So you could get, with the right weighting, a 2% annual monthly return from a portfolio of these top stocks in market capitalization. Now you can see here from the picture that, there was negative returns in 2022 on a monthly basis. There was a big spike in up and down during the COVID pandemic. And basically, they kind of all look the same. So they did track by and large because the underlying stocks are the same. So my main point here is this is just getting us set up for what we're going to learn as we go through this. All right. Top stocks by the largest 1 month percentage change in the forward annual estimate for Retail-Wholesale for these 8 years. So here we've got Darden Restaurants, which is a big restaurant chain, Domino's Pizza, Restaurant Brands International. This is Burger King and Tim Hortons, Booking.com. This is travel stock group. Over here we've got Dollar General, and over here we've got Target. So Dollar General, Target, of course, these are big discount retail players. These Darden Restaurants and Domino's Pizza and Restaurant Brands International, they're over in the restaurant business. And of course, we have Booking, which is in the travel business. So over these 8 years, you can see that these only Domino's Pizza did as well as sort of Costco and players like Amazon. So standard deviation returns, somewhat a little higher here, 8 or 9s. And of course, what we get down here is, again, a nice correlation matrix for Target to everything. No, to no surprise, the 0.5 is with Dollar General. They're big industry in that industry. And they're leastly correlated to Domino's Pizza, which makes sense. Target and Domino's Pizza are very different businesses. So keep in mind here, sometimes, for example, Dollar General and Restaurant Brands International have very low correlation. So from the perspective of that would be interesting to note and be aware of. So down here, we've got the equal weights. We've got the overweighting the back 3 here, and then, of course, overweighting the front 3 here. Actually, it looks like we've got a little different strategy here. So we're going to do this a little differently. Now, what happens? Well, it's, again, showing you that weighting the top stocks, Domino's Pizza, basically, you got to get it in there, and it worked out a little better for you. You got an 18% annual return, lower than the first one. So again, largest 1 month percent change did not do as well as the largest stocks in this area. So that's worth noting. Let's get to the next one. This is maximum number of analysts. So Shake Shack, Texas Roadhouse, Decker's Outdoor, Abercrombie and Fitch, Builders First Source. This is going to be another fascinating mix of companies. Sprouts Farmers Market, I forgot about that one. That is a big grocery chain, particularly out in the West here. So cumulative returns. Texas Roadhouse was really strong. Abercrombie and Fitch was strong. Builders First Source was outstanding, as was Deckers Outdoor, which is a shoe company based here in Goleta, California. It's a suburb of Santa Barbara. So Deckers and Builder just killed it in this maximum number of analysts. So you might want to pick up this idea that the number of analysts covering a stock really matters to its performance. And keep that in mind as a screening criteria. Compound annual growth returns, Deckers was 44% for Builder and Deckers. You could make 40 to 44% annually if you pick those two stocks. Shake Shack actually didn't do that well. Look at that. It's actually worse than Walmart. And Sprouts Farmers Market, a grocery store, you're only going to do 10% return. Even a good picked one like this one that's well followed did not do that well. So over here, you can see Sprouts Farmers Market, in the 0.1s with correlation because of growth. Grocery stores are really not the way to tie into the overall beta of the market. Shake Shack, of course, really strong here, and that's notable and should be picked up. So again, we're going to do the weighting here, equal weight. Then we're going to do these two big stocks. And then later on, we're going to do those two big stocks and Sprouts Farmers Market. So again, look at this. You could get 37% annual returns with the right weighting in this portfolio. So maximum number of analysts in the retail wholesale space really mattered a lot. And this really shows you that you pretty much nailed it if you use that as a screening criteria in this space. 3% monthly returns. Pretty much, you get the big sell-off in the 21-22 period. But by and large, you really did quite well with these portfolios. So keep it in mind. Maximum number of analysts actually won out. Now, if we do three criteria, and the note here is down here, the top two in market capitalization, top two in largest 1 month percent change in forward estimate, and the top two in maximum number of analysts, of course, Deckers and Builder. So let's throw all those in, the top players together. What do we get? Standard deviations, of course, a little higher than normal, but annual returns, super nice looking stuff here. And then, of course, we look at Deckers Outdoor, who it compares to. It generally gets a higher correlation with the higher performing stock like Chipotle. So you can use a correlation matrix to Deckers to actually identify the other strong performing stocks, which is interesting to note. All right, so what you can see here, actually 33% returns. If you weighted this right, 32% returns here, and 6 or 7 standard deviations is not bad. So again, fascinating stuff here. Use the correlation matrices to understand stocks and the relative performers that are going to track with them and get to know their differences in portfolio context. Really did help us out. All right, so on to consumer discretionary stocks. We're going to switch gears here and look at these types of stocks. So what do we got here? All right, this is Louis Vuitton Moet Hennessy, the big company in Paris. This is Netflix. That's obviously, that one, streaming giant. Sony, Sony, that's the Japanese company. Nintendo, the games company. Marriott, the hotel company. And Lululemon, the yoga supplier of clothes up in Canada. That's now global, basically. Compound annual growth returns, down as low as 16% for Sony, the Japanese company, but 25%, pretty much standard for the other players. Netflix was almost identical to Lululemon and L'Oreal and LMVH. So standard deviations here again, for example, LMVH, 25% with a 7 standard deviation. It's a really solid performing stock with not a lot of variation. So their portfolio strategy as a company, being a conglomerate, really did work out well for them. Okay, so let's look at Sony's correlations here. All below 5, not tightly related, and basically not closely aligned. So that tells you something here. Marriott is aligned with Moe had his LVMH. So that's interesting to note. Picking that up, the travel business, of course, and leisure products that are bought by people at LVMH. These are Louis Vuitton and things like that, bags and purchase. It gets into the Chinese, shopping in Asia kind of thing. They're actually quite tied, which is interesting to note. Like I said, over here, annualized returns 25%, basically with 6 standard deviations. So much lower standard deviation with 25% returns. Again, pretty solid performance for market capitalization here. 1 month percent change, different Nike, we got Under Armour, we got Hyatt, we got Comcast, we got Electronic Arts, and we got Take-Two. And of course, the standard growth of returns is kind of weak, actually. Under Armour didn't do actually quite very well because it was, doesn't perform and had a lot of variation. So this one didn't work out too well. Under Armour's correlations really low and poor. Nike may be the better one, but again, not very strong. So this didn't hold stocks together very well, and it didn't offer much in the way of returns for this particular sector. So keep this in mind. Again, you're looking at 1 or 1.5% returns on using this metric, which didn't turn out well for this particular sector. Number of analysts. So now we're back into that game, and we're seeing a much different story here. Again, lots of different variation. We want to look over here and notice that, again, it's not clear that these stocks are related to each other in this particular space at all. Annualized returns, down in the 15% area. This is actually quite low, so we should probably discard this particular subject right away. All right, now we're going to enter the criteria of picking the top 2, Louis Vuitton and Netflix, Hyatt and Take-Two, and over here, these 2 names in that space with forward estimates. So if we look at all of this, of course, there's a cumulative returns, and we've got some nice performing stocks here. And if we use Netflix, just go across the top here because we know about it, you can see this related to the forward estimates is very low versus the market caps and the number of analysts. So Netflix did actually trade better on this. These are kind of the stocks that got picked up out of the system that we didn't use very well. So looking on, we can get 25 to 28% returns here. So this is really excellent. I mean, we can get almost as good as we got in that first area with retail wholesale. So retail wholesale does actually look like it was stronger than consumer discretionary by 3 to 5% if you get the right stock. So keep that in mind. So we're getting to the last one. Of course, this is consumer staples. These are the more defensive names, more necessary names. All right, so who do we got in here? Procter & Gamble, L'Oreal, PepsiCo, Mondelez, Wolters Kluwer, which is a European-based multinational publishing information financial stuff, like a Thomson Reuters type thing. Thinking Coke, of course, Coke and Pepsi, we should expect those to be somewhat similar. Mondelez and Procter & Gamble, perhaps somewhat similar. And of course, we're going to want to understand L'Oreal and Wolters Kluwer because those are European companies. So annual growth in returns is actually like down in the 10s, not the 20s or 30s. Standard deviations obviously a lot lower, the 4s and 5s, not the 7s and 8s or 6s. So what we learn here from Coke is that basically Wolters Kluwer and L'Oreal are not totally related to Coke, but Coke and Pepsi get a 6.5 or 7.5, and Procter & Gamble is a 6.5, and Mondelez is a 7.1. So these correlations are quite high. But Coke is related to its competitors quite well, and that should be kept in mind. Here's our portfolio weighting, and over here we got annual returns of 15% if we picked up the right stocks, 10 or 11% if we did. Much lower standard deviations down in the 4s. So lower returns and lower risk for this particular portfolio. You can see this in the charts. It's just not bouncing around as high or low. So let's move on to largest 1 month percent change in forward estimates. Here's Hershey, of course. Philip Morris, Restoration Hardware, Monster, all these different stocks that are in this space. So what do we get out of returns of growth earns? Again, very, very weak, low. Let's look at Philip Morris and look at their correlations, and also they're quite low. So again, 1 month change in estimates, things are not relatively related to each other. We were learning this. Returns are actually quite good, a little better, I should say, if you got, particularly if you weighted the right ones. You got a weighting on Hershey basically, and Monster, you did a little better. So Restoration Hardware was the star of the show. And if we got weighted it right, which we didn't do this time around, it would have turned out better. So maybe it's true that we should have taken a little more weighting on Restoration Hardware. But again, would I bother with this? Variation's pretty high, and returns are not as great. So I would not bother with this story. Number of analysts. All right. So here's your stocks: Elf, New York Times, British American Peco, all these different good names. And we can go down here and we can see very low correlations. And here you can see very strong returns in this space. You can get up to that 28, 29 in this space if you own FRPT and ELF, which is the cosmetics group. So these were really nice stocks. There's a 40% return. You want to look into FRPT. That is a really strong stock and did quite well. So there you have it. On to one last slide, the composite of the tops. Those are picks in these two areas, and those two areas, and these two areas. And what you get is, yes, 28 or 29% returns. You can actually get that good of returns in consumer staples using all three. So this time around, using all three metrics and picking the best stocks actually played out well for you. So there is a lesson here in not actually using the same criteria in these sectors, because now you can see here this was really quite good. You get 6 standard deviations and annualized return close to 30%, really strong in consumer staples using this criteria. So this actually, using it and cherry picking the three of them, actually did work out well. Interesting. So thanks for attending. That's all I have today about portfolio management in these sectors. I hope you learned something about how to manage your portfolio and how to pick top stocks and how they track one another by industry and by performance. All right, so you can get a hold of these slides at 866-794-6065. Strategy call at zackspro.com or on the web at www.zackspro.com. All that stuff is really critical. You got to get the slides, of course, when data like this is available, because that's the data is really what the story is all about. So let's do this one more time. 866-794-6065. Strategy call at zackspro.com and the web www.zackspro.com. And of course, you can find us on LinkedIn and Twitter. That's it for me, folks. I hope you enjoyed it.